Welcome back. You're watching Business Week on Arise News. Well, one economist calls it the great miscalculation. Efosa Ojomo, senior research fellow at the Clayton Institute at Harvard, was referring to the optimism of multinationals who had entered the African market and were now exiting. He later goes on to argue that doing business in Africa is hard, not because there's something particularly wrong with Africa, but simply because of the stage of Africa's development. We have had a wave of exits and divestments from sectors like FMCG and manufacturing in Nigeria and across Africa. Nestle SA in South Africa in August last year shut down its production facility for chocolate milk in that country, citing falling demand. In 2023, Unilever PLC pulled the plug on the manufacturing of home care and skin cleansing products in Nigeria to sustain profitability, while pharma giants like GSK have outsourced distribution of their products to independent companies in Kenya. But we've also seen new capital inflows into emerging sectors like fintech and renewable energy, health, as well as education. Are we reading too much into these recent exits? Aren't infrastructure policy or regulatory challenges common across many economies of the world? Don't these exits provide ample opportunities for local companies to gain market share in key sectors? Well, to help me answer some of these questions and much more on Nigeria's investment environment is Dr. Ike Chioke, MD of AfriInvest Limited, who also recently became the chairman of the Enugu State Security Trust Fund. Good morning, Dr. Chioke. Great to have you on Business Week for the first time.
Good morning, Raleka. Pleasure to be here.
Yes, indeed. Of course, a much talked about story has been the exit of multinationals.
Yes.
Is there a trend with these exits that you can point to?
Well, the trend typically happens when you have a macroeconomic sort of challenge. And you see, for example, in Nigeria, in the last, say, 10 years, we've experienced 2 recessions. The first was in 2016, and then we went through that and came up in 2020 with the COVID recession. So around 2016, when we had a recession, you can see the variables moved quite a lot. So something like growth, we were at about 6.5% GDP growth. That went down to 1.9%. But what was more important was exchange rate went from about 170 at the official market to 360 from 2014 to 360 by 2018. So that, again, created a challenge for multinationals. And that's where you saw, for example, the initial size of Unilever downsizing, GSK. We then had, obviously, companies like even HSBC leaving Nigeria, UBS shutting down their rep offices. So that gives you a signal of what can happen. Move further up to 2020 era with COVID. We saw, again, contraction. At that time, Nigeria went into negative growth rate. Exchange rate now was around 360 official. But you also notice now they have begun to creep a spread between the official market and the apparel market. And we had something like 440 at the apparel market. Now, by the time you now come into 2023, that in January 2023, we were still sort of around 360, while the apparel market was now 740. The gap had widened. So in addition to sort of that change in the variables, the macroeconomic parameters, something I call economic arbitrage, which the central bank did not manage well at the time, also created a problem, which is what has created the recent trend. You see Jumia Foods has exited, Microsoft has shut down. Even back in 2017, Etisalat left Nigeria. So those kind of variables can often create the capacity to wipe out the entire equity capital of a company that has operated in Nigeria for years. More recently, you've seen Diageo has just exited and sold to Toleram Group.
And you know, that's an interesting example because you have Diageo that exited, but it's sold to another foreign investor, right? So
the Toleram Group is interesting because they're actually a Nigerian company originally, but they've been here for a very long time. And Haresh, who's the group managing director, Haresh Aswani, has doggedly managed Nigeria and grown his enterprise from Nigeria
locally
to the point where he now is based in Singapore. But it's someone who has a familiarity of the Nigerian challenges and can see that sometimes there are ups and sometimes there are downs. But you know, when you think about the economic arbitrage that crept into our economy between, I would say, probably from 2016 until 2023, where there was this massive spread between the official and the apparel market, that can impose
Absolutely.
very strong disincentives for multinationals to remain.
Yeah.
Etisalat is a particular one where you had the official market at 360 and they needed to sort of repatriate their profits, but they didn't have liquidity in that market. It was to go into the parallel market, and that created some of the concerns that led to the company leaving Nigeria.
Yeah. And you know, one common theme out of everything you said has been the exchange rate.
True.
So we can't, overemphasize the role of the exchange rate. But a lot of these multinationals also have businesses and subsidiaries in other countries. So how much would you attribute it to more global portfolio rationalization, maybe to homegrown factors in their own home economies versus primarily driven by factors in Nigeria or the countries they operate in?
Okay. I'll answer the Nigerian one. The exchange rate is also a driver of the consumer capacity to purchase.
Of course.
And there's only so much you can do in fragmenting that product. So someone like Procter & Gamble, you cannot fragment the soap you're selling,
into
smaller pieces. There's a limit you get to, and then you realize, actually, these consumers cannot afford it anymore. I cannot operate profitably. Because if you think about the Nigerian consumer environment, and take a point in time like 2004, just after the banking recapitalization at that time, at 18,000 naira per month minimum wage, that worked out to $138 per month.
Wow.
Today, at 30,000 naira minimum wage, you're barely at $20 per month. So you can actually see the complete compression of the purchasing power of Nigerian consumers relative to goods that are made by multinationals. Now, then profile the rest of Africa. Multinationals make rational decisions. Nigeria, I have to say, hasn't done very well in creating what I call an attractive environment to bring in multinationals and keep them for a long time. If you look at FDI flows, foreign direct investment flows, in 2014, Nigeria and Egypt were comparable. Nigeria got $4.7 billion that year. Egypt got $4.8 billion. Fast forward to 2023, Nigeria has collapsed to $2 billion of FDI flows. Egypt is at $107 billion. If you think about Kenya, it was only $0.9 billion in 2014. It's grown to 2.1 as of last year. Morocco was $3.7 billion in 2014. It's grown to $21 billion. So clearly, multinationals, when they are faced with these issues of what I call an economically hostile environment, and they are seeing other economies where they can go in and their money holds value and there's a consumer demand and they don't have to deal with other extraordinary factors like, what I call state capture, particularly the issue between the official market and the power market. There's one single exchange rate. Then that enables them or that encourages them to make that rational decision.
Very interesting.
Conversely, some of these countries actually make a deliberate effort to go and pitch to multinationals and give them a basket of incentives to bring them into their countries. I don't think we've done a credible job sufficiently in that area.
Those are very interesting comparisons because Egypt even has its own macroeconomic challenges, but we're still seeing investment flows.
Even South Africa has challenges. South Africa is at $20 billion of FDI flows last year.
That's very interesting. So I want to ask you, because at the top of the show when I was introducing, I referred to this article that had been done by a chap at Harvard, Efosa Ojoma, where he said the great miscalculation, which is that multinationals and investors had miscalculated, maybe were overly optimistic on the African opportunity, which I don't believe is the case. I think Africa is a ripe ground for investment. But do you think there's an element of people overstretching themselves and assuming because they're big consumer markets that it would be plain sailing in many of these economies?
I think there is that element. But if I think about the way at AfriInvest, when we make a decision to partner with a company, it's not really the fundamentals of the business they're doing. That's important. It's not even the fundamentals of the industry they're in. That's important. It actually goes back to the individuals that are running the company.
Sure.
So the character and the discipline and the track record. And I think sometimes international investors have not looked too closely at the leadership quality in some African countries. And some of the economies I refer to, they've had more stable political leadership environments And that has helped them maintain a consistent policy environment to grow and sustain and attract foreign investment. In other areas where Nigeria, quote unquote, has a democratic environment, but I think that we have been challenged by leadership that hasn't done enough of sacrifice in order to encourage and support Nigeria to attract the sort of investment environment it requires.
Yeah.
So across Africa, of course, you've got natural resources, you've got arable land, you've got a low penetration of technology, you've got the opportunity to build infrastructure. So there are fundamental gains for international companies to come. And what they are doing is selectively choosing the right countries to be in.
Absolutely.
I wouldn't say that they've miscalculated. What you can see is that they are, in some cases, they pull back and simultaneously they move into another region.
Right.
Nigeria, remember the recent ExxonMobil announcement? They decided that, you know what, they have not invested a dime in Nigeria in the last 2 decades. But they just announced a $15 billion investment in the Angolan oil and gas industry. And that's because we spent 20 years working on an oil and gas bill, and the current version is still not attractive enough, and they decided to move their business elsewhere.
Yeah, very interesting on FDI. Let's move to another type of investment.
Okay.
So the capital flows, the hot money, the portfolio flows, much of which goes into our fixed income markets, government bills, bonds, as well as equities. Let's talk about the performance of the Nigerian equities markets. What's been the main driver performance on the equities markets this year?
We've seen that a basket of policies from the central bank have also attracted international investors, the high interest rate environment. We've noticed, for example, foreign participation in the equity market has gone from just about 9.1% in the last quarter of last year to 20%.
Okay.
So that's encouraging.
That's a different narrative because on the FDI side, we're seeing some divestments.
Correct.
Yeah.
You know, so people are then saying, okay, well, and on the back of that, you also see strong earnings momentum from the banking sector, from industrial sector, from consumer goods, albeit some of them have come from FX revaluation, like in the banking sector. Dividends have been good, although banks have been constrained in the dividend side. All of that has driven up the market. We've also seen some announcements of transactions, like Seplat has, now announced the conclusion of this ExxonMobil asset is acquiring. Similarly, Oando on the Ajib fields. More recently, Okan Saffron.
Yes.
It's an entity that belongs to the Saro Africa.
Palm oil.
Yeah, that bought into Seat, which owns Presco. And if I think about the fundamental momentum on those stocks, all of them have gone up about 50% year to date. The market overall is at 33% year to date. Yeah. Albeit the banking sector is down 8.1%. And the banking sector is obviously challenged because some people are thinking, recapitalization, what's the impact? The dividends are a bit lower this year because CBN has constrained the banks from paying dividends out of FX gains.
Right.
So, and of course, these guys need to shore up their capital and they're thinking of, do I need to pay out everything in terms of dividend? So, all together, we see there's momentum in the equity markets. That's also driven by the fact that you see, some of the monetary policy parameters are encouraging money to stay a little bit longer in Nigeria before exiting.
Yeah, that's very interesting. Earlier in my show, I was talking about the fact that India had now entered the JP Morgan index. Okay. And Indian government bonds were going to now be more attractive for inflows. Nigeria was removed from the MSCI index. And I think if you speak to a lot of foreign investors, that's one of the things they tell you has not really brought them back to the volumes we saw in previous years. Yeah. So from attracting inflows to the market, in terms of our fundamentals, looking ahead to the next half of the year, what do you expect should further drive investor confidence in the capital markets?
You see, I mentioned that the banking sector is down 8%. If the banks begin to recover, if we see more momentum, for example, in the current capital raising, Fidelity has announced their, hybrid of their offer, which is offer for subscription and rights issue. We expect more banks to begin to announce their offers by the second half of the year. So once that begins to come up, Dangote Sugar is a bit down as well. we think that could move the market from the 33% threshold to about 45%. Now, there are also rumors in the market that Dangote refinery could be listed. Such a listing, if you think of a $20 billion investment coming to hit the market at a valuation of 30 trillion naira.
That would be incredible.
That would be incredible. That would also
cap
push
is at about 55 trillion
56 trillion now.
56 trillion, yeah.
And there's a Aradel as well. That could be a 1 trillion naira addition. So potential new listings can also help the market. You saw, for example, when Transpower came in earlier in the year, that was a 1.6 trillion naira addition to the market. So the momentum on new listings, the momentum on capital raising from the banks, and the correction of some of the recent undervaluation in some sectors could leave the market. We think our base case would be around that 45% year end.
Okay.
But our optimistic case, if these new listings come in, could be much higher.
Yeah, I mean, thinking of some of these big national giants, who are actually also regional giants, because some of them have a presence in other African countries, the potential is huge.
Indeed.
You know, the government has an ambition of a $1 trillion economy. I know some people sort of scowl at that and say how we will get there. But if you look at the trajectory of many of our companies, homegrown businesses, it's not inconceivable that they could contribute to Nigeria's GDP in a big way. But there's one policy issue I'd like to sort of hear from you, your thoughts on how it's likely to impact the economy, which is the overall banking sector recapitalization.
Okay.
What impact do you think it will have on economic stability in Nigeria as a whole?
Well, economy has been challenged. I've mentioned some of the parameters. You know, if you think about even inflation, it's gone from 24% last year to 34% now. The exchange rate has gone from sort of average of about 400 or so last year to now 1,500. Luckily now, there's no spread much between the parallel market and the official market. But for the banks, remember it was in 2010 that we created this tiered banking structure where international banking license, you needed 50 billion naira to be there. National was 25 billion. Merchant banking, 15. Regional 10, and a non-interest banking at 5. Now, the central bank has gone on with policies that say, okay, international banking license, you must have 500. But if you actually look at 50 billion in 2010 in real terms, adjusted for the dollars, to 500 billion now, it's only a 30% increase.
Not a whole lot.
Not a whole lot. The change for national license is more significant. It's going from 25 to 200. That's about an 80% jump. But the others actually have gone down. You know, if you think about 5 billion in dollar terms. But overall, the rationale for the banking recapitalization is obviously to help stabilize, you know, the economy, whole macroeconomic challenges. As the banks are raising money, they're also having more capacity to be able to support their customers and be able to operate at the same level as they used to do. Because a bank that had the equivalent of $300 million of capital in 2010, and today that has gone down 90% to something like, you know, $40 million of capital. Definitely needs to come back up if you want to support the same oil and gas players that are in the same market.
Absolutely.
Whose revenues are in dollars and whose borrowings are in dollars. So that's important for macroeconomic growth, momentum. It's also important to stabilize the banking sector and give them the buffer to take in any losses. And you know, in a difficult environment, some companies may have borrowed and they may not have the capacity to pay back.
Absolutely.
So the banking industry must have that buffer to take in some of those losses. And last but not the least is the momentum it gives to the economy. Because in this case, the amount of capital the industry will require, we've estimated is something like 4 trillion naira. We don't think all of that is available in Nigeria.
So we're likely to see some consolidation.
Not just consolidation, but some capital inflows might come in to support. So that foreign direct investment, that is needed. And that also helps to stabilize the exchange rate, stabilize the Nigerian economy. And that's all positive overall.
So I have time for one more question. I don't want to put you on the spot. But looking at we're in June now, July to December. If you were to say that there is a single policy catalyst that would ensure that Nigeria ends the year well from an economic perspective. Now, it could be a policy catalyst that's already in play, and we just need more of it. What would it be? Where do you think the focus should be?
That's interesting.
Damn question, I know.
I think the biggest policy catalyst actually at the political arena is not something from the central bank or the Ministry of Finance.
Okay.
I think the biggest policy catalyst is the leadership. I think, and that's my personal opinion, that we have seen a complete disconnect between the leadership and the citizens. and the social contract has been severed. And you see all this noise about the spending at the top political echelons. Meanwhile, at the bottom, we're still discussing whether we should pay a living wage. And so 30,000 naira per month works out to $20 a month. Whereas only a few years ago, the minimum wage was equivalent to $138 a month. We have to recognize that. And that policy catalyst would require some restraint and discipline from the political leadership and allow the savings, particularly the hidden aspect of the budgeting is what they call overheads. There's a whole lot of numbers that go into that overhead thing. And I've looked at it and I don't understand it. But the more you can pierce through, you find there's enough fluff in there to pay living wages.
Yeah.
If you did that, then that would catalyze the discipline of leadership, and the opportunity to pay living wages will certainly ginger the Nigerian economy, in a word.
And I think we can take a leaf from Kenya's page, because it's a similar story, really.
Well,
yeah.
We don't want to get to that point.
We don't want to get to that point, but in terms of leadership listening to the voices of the people. Dr. Ike Chioke, it's been a fantastic conversation. Thank you so much for coming on the show and offering from your wealth of insights and experience.
My pleasure.
Thank you.
Thank you.
Well, that's all we have time for in Business Week this week. I'm Rolake Akingbe-Filani. If you want to continue the conversation, you can find me on X. Do have a lovely rest of the weekend, and I'll see you next time.